Valuations have absolutely been insane for a while now, but most investors still think this is the normal way the market should be. I'm seriously concerned that what's coming up next will hit harder and faster than most people expect when it finally does come, because it will. Here is what I'm seeing. Imagine you're at an amusement park. There's this roller coaster, huge, shiny, everyone's dying to get on it. It goes higher and higher, and people are cheering, they're throwing their hands up like, woo, it's the best ride ever. But here's the kicker. The brakes, they're busted. That is the stock market today. Now listen, I know everybody feels like they're getting rich right now. Prices are going up, tech stocks are flying, and it's like that money printer won't stop. But here's the truth. This market is way overvalued. And that's not just me being a futster. The numbers are screaming it. I'm not here to tell you an exact date there's going to be a crash. I'm not here to tell you that you're going to be poor and the U.S. economy is falling into... Not at all. We have had crashes in the past. We will continue to have crashes in the future. But let me break this down. We are looking at valuation metrics that we have not seen since the 1920s, when we had the stock market fall 86% from its high in 1929. We're talking about valuations being double what they were during the dot-com bubble. Double. I created my own stock market to GDP ratio. This is the most reliable metric at any given time, according to that very old dinosaur Warren Buffett, who still beats the market every single decade. Guys, in the last 10 years, he has beaten the market by 2.6%, and yet people still call him a dinosaur. All that time, his cash keeps going up and up and up and up. He's getting practically no return on that cash and still beating the market. So I went back to like 1870 and put the metrics here, making my own S&P 500 type stock market to GDP. And guys, here's where we are as of right now. 116.62% overvalued. Well, Paul, the thing about the stock market GDP ratio is it doesn't look at companies that make money abroad. Whatever you want to do to make yourself feel warm and fuzzy inside, go ahead and do. But I know you're watching this video because you probably are at least inquisitive of what this all means. So for those who say that, I also look at the 10-year cyclically adjusted PE ratio. That's a fancy way of saying that we take the last 10 years of earning of the S&P, no matter where it's earned, whether it's Tennessee or Timbuktu, we bring it to today using inflation, and we look at the PE today on that stock, on the stock market. Well, guys, newsflash, we're 119% overvalued. 119%, worse than the stock market to GDP ratio. Current valuations make no sense if you believe that every investment is the present value of all future cash flows. Every time valuations do this, people say the same magic words. It's different this time. Spoiler alert, it never is. Now I know you might sit there and say, I'm not saying it's different this time. I'm just saying that right now AI is changing the world, blah, 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 blah. That's another way of saying it's different this time. So guys, let's talk real numbers. As a prime example of overvaluation, Tesla, I think, is one of the poster children of this entire bull market. In 2024, they sold 1.7 million cars. That's great. It's a huge achievement for such a young company. But here's where it gets crazy. You have big voices out there. Kathy Wood of ARK Investment, for example. Back in 2022, she said her bear case. Now, what's a bear case? A bear case is her worst case on the company. They absolutely fail. Was that in 2026, they would sell, drumroll please, 10 million cars. Guys, that's next year. Now, meet Kevin, who ironically I got in a little YouTube beef with a few years ago because he said to me, oh, there's guys out there who say that Tesla's a car company, they compare it to Ford. And he made fun of me. Well, he expected 6 million cars in 2025 as part of his conservative assumptions. Guys, you might sit there and say, well, they were wrong. You're right, they were wrong. And everybody's allowed to be wrong. However, when you're unreasonable with no process and you just get justified because price keeps going up, does that make you wrong or does that make you have the wrong process? Now, let me ask you something. How do we get to 10 million cars from 1.7 million in the next 18 months? That's nearly 6 times the current production. And yeah, they made these assumptions in the past a few years ago. But guys, 2022 for Cathie Wood wasn't that long ago. It wasn't like it was 2015 and there was insane projections. The funny part is that's a small example of the entire market. And the worst part is the market is valuing Tesla today like it already hit those numbers. In fact, maybe even higher. We've done videos in the past where we talk about Tesla, we break down the numbers of profitability and all these other things, and basically they have to sell 15 or 20 million cars per year, plus sell 50 million cars on their self-driving. Guys, they're not even getting 2% conversion from their free self-driving. They have to drop the price from $12,000 to $8,000 to $99 a month with a 3-month free trial, and only 2% of the people in the free trial convert to actually paying. That's Tesla. But this is the kind of thinking that makes all stocks go to overvaluation. When we feel warm and fuzzy, we see stocks going up, we can't miss out, we have this FOMO. When investors buy into a company based on dreams and projections instead of actual results or reasonable projections, oftentimes they're going to set themselves up for disappointment. Yes, are there times where it works out? Absolutely. But we have that problem of selection bias when we see that. It's the ones that made it through. Tesla's been overvalued for a large chunk of its history. Absolutely. But how many other electric car companies didn't make anything? In fact, went to zero. The numbers are countless. Now here's the bigger picture. We have the Magnificent Seven: Apple, Microsoft, Nvidia, Google, Amazon, Meta, Tesla. All of these companies, they make up currently 34% of the S&P 500 market cap. That's just 7 companies holding up over a third of the 500 largest companies in the US stock market. If they stumble, they will drag down the entire market. That's what happened in 2022. This is exactly why I use math in addition to the stories. The stories are wonderful, the stories are great, but it's our 5th and most important tenet of principle-driven investing. A great story can become a bad investment if you pay the wrong price. You got to marry the story with the numbers together to come up with the right price to pay for an investment. So when everyone's paying all these insane numbers, assuming the future is going to be absolutely guaranteed, I'm the guy saying, guys, let's just temper expectations a little bit. A lot of people out there will say, oh, you're a fudster. No. I have countless examples of times when I was buying companies that were out of favor. I have 28 companies right now that people think are out of favor that I currently own. So what causes overvaluation? Let's clear something up. Bubbles don't start with lies. Bubbles start on a very sound premise. They start with the truth. They start with a good idea. They start with something that makes perfect sense. Example. Right now, we're dealing with an education bubble where people have too much education debt. Rewind 25 years ago when I was entering college, and there was no price too high for a college education. College education is the most important thing. Go to the best school you can. Fast forward, we have a problem. Real estate. Owning a home is the American dream. Okay. And then in 2003, 2004, it started to get a little crazy. In 2007 and 8, it almost brought down the financial system. Investing in stocks is absolutely necessary for the future and for your retirement. Absolutely. But now it's getting a little crazy. Like it gets crazy every 17 or 18 years. But that craziness can both be crazy on the high side and the low side. The start of the biggest bull market in history was a few months after Barron's magazine put on the cover the death of equities. From 1966 to 1982, the stock market went nowhere, literally flat. From 1982 to 1999, a similar 17 years later, the S&P went from 110 to 1550. It 14x'd. When the previous 16 years, it was flat. From 2000 until 2012, S&P was flat. Do you see a pattern forming? This happens every 15 or 17 years. You go back to 1870, the same thing happens over and over. They're called secular bull and bear markets. They're long-term bull and bear markets. Everyone in the late 90s and early 2000s was pumped about the internet. It was changing the world. Guys, guess what? It did change the world. But everyone acted like every .com out there with just an idea and a .com attached to its name was the next biggest company out there. It didn't matter if it had revenue. It didn't matter if it had anything more than an idea. It was worth immediately billions of dollars. I remember marketwatch.com, the very MarketWatch you know, went public and went up 600% in the very first day. And then guess what happened? The bubble popped. The NASDAQ ended up falling almost 83%. A lot of those companies went to zero. Why? because the investors bid up the price too far. That's purely it. And the companies that did survive, guys, there are several examples, two notable ones, Intel and Cisco, that are much bigger businesses today than they were back in 2000, yet their stock has not surpassed their 2000 high, even though they have multiples more in revenue and more multiples than that in profit. Imagine you're sitting in 2000, you buy Intel, you buy Cisco, and they say, hey, 25 years from now, these companies are going to do 3 times more revenue and 4 times more profit. What would you have said? You said, oh, these stocks are going to go straight up, and they did not. And it's not like those companies are selling super cheap right now. Intel, I think, is, but they're going through a little rebound right now, a little reorganization. But guess what? The thought of Intel even having problems back in 2000 was an absurd thought. Same thing happened in 2008 with the real estate, like I talked about. You were dumb if you had real estate. Fast forward 2 or 3 years, guess what? Real estate was toxic. It was a toxic asset. I remember getting in arguments with banks because I bought real estate after the crash and they wouldn't give me loans. I had to pay cash for the real estate. Why? Paul, these are toxic assets. I'm like, hey, assholes, this is the asset that you lent $120,000 or $150,000 on just 6 years ago, and now you're telling me you won't lend me $1 on it? They're toxic assets. We want to have nothing to do with them. Great. Good for you guys. The same banks, the same bankers, the same level of arrogance because they didn't understand that price determines everything. Owning a home is a wonderful thing for plenty of people. But if you take it too far and it starts to go out and out and out and out and get a little crazier, you don't notice it. Guys, look at you. On any given day, you don't look any different than the previous day. But if you took a picture of yourself today and took a picture of yourself 6 months from now without cutting your hair, how different would your hair look? You're the frog in the boiling pot. You don't notice it, and then all of a sudden, it's a little too hot and you can't get out anymore. But guys, every bull market starts with the truth. But when that narrative gets a little too crazy and it's only about the narrative, then what happens? People become optimistic and they build. And the ones who are naysayers get on board. And then all of a sudden everybody's on board and it's easy to make money. That is exactly what a bubble is. So whenever you hear some sort of variation of it's different this time, or this is the future, or it can only go up, or assumptions about growth in the future is just don't worry, it'll take care of itself, or the thought that stocks can't go down a lot. Because once they go down, they bounce right back up. 2020, we had COVID, 37% drop in 1 month, right back up. The year ended on a high. 2022, we had a little bear market. The NASDAQ fell 20-some%. The Mag 7 fell 35%, right back up again without even an issue. We're not learning the right lessons when we see these things happening. It becomes about the ticker symbol and the price going up, not the fundamentals of the business. And don't get me wrong, Mag 7 companies, they're wonderful businesses. They're great businesses. They will be around for a very long time. The question is, what will their stocks be doing 10 years from now? Guys, what do you think? Do you think it feels like making money is easy in the market? If you think that, I don't blame you. Every time I wake up or go to the market or get to the office and finally check the market, I'm like, oh, I wonder how much is up today. I just assume it's up. It's always going up. Let me ask you a question. Who's talking to you about stocks right now? Is it a few smart people or a bunch of average people? I think that tells you exactly where we stand. When I hear average everyday Joes who have no business talking about investments, but they talk about crypto and how it's the future, and they repeat every little thing about crypto that Michael Saylor says, I know we have a problem. But of course, we don't have a problem until we have a problem. But I feel like we're in a room, as John Husband says, filled with gasoline, and there's a big fire raging in the corner. There will be a spark that causes the explosion, but I don't know what that spark will be. When I see the best investors of all time all being made fun of because they're dinosaurs, because they don't get it, and they have underperformance, that to me is a sign of how overvalued the market is. That doesn't tell me those guys are past their prime. It means there's a big disconnect. Guys, Jeremy from Financial Education, we had a little YouTube beef as well. And we once had one of our people go reach out to them to see what they said. And they said literally, we expect 20% returns a year for the rest of our life. Guys, Warren Buffett did 20% a year for his life. Are you kidding me? And he was basically saying he was going to do that. That's absolutely insane. What does overvaluation mean? It just means people are paying too much for a future stream of business. If I told you right now that in the next 5 years, I was going to pay you this stream of cash, $1, $2, $3, $4, and $5, and then be done. What would you pay for this? Well, first off, this is $15 total, right? So if you paid $15 today, guess what? You broke even. You made zero money over 5 years. So would you pay $15? Of course not. Would you pay $5? You triple your money in 5 years? I would hope so. So somewhere between $5 and $15 is probably some right number to pay. But there's a lot of factors involved. How likely am I to stay around? Am I going to go broke where I can't pay you? Are you going to die and all of a sudden you can't get paid? All these things matter. But with companies, we don't know the future, so we don't know what they're going to make, right? So we have to make these assessments. But the funny part is, when we have these stories built up, we don't think it's even possible they don't hit those numbers. We build them up in our head. It's like falling in love all over again. This person can do no wrong. This company can do no wrong. And that's when we get into trouble. The biggest poster child of this bubble is cryptocurrency. I know. It's at all-time highs. Bitcoin's at all-time highs. Guys, cryptocurrency and the people who support it are exactly what I mean when I say this market is insane. I literally don't have a single person that I respect in this world that likes cryptocurrency. No offense to people that I might know that have it. I just look at it going, you're all idiots for calling it assets. If the market for cryptocurrency went away tomorrow, how would you make money? But if the stock market went away tomorrow and you owned shares of a company, you would still own a piece of that company. And that company would still increase its revenue, increase its profit, pay you out dividends. And when the market reopened, it'd be more profitable and the price would adjust. That would not happen with cryptocurrency. Cryptocurrency is a prime example of the greater fool theory. People buy it hoping somebody else will pay them more. And of course, it's masked behind a story about it's changing finance and all that stuff. No, it's not. It is not going to change finance the way people say. In its current form, it's getting there to be able to be what would be accepted. But the original intention of cryptocurrency was off the radar, non-traceable. Guys, let me ask you a question. You hear these stories about people losing their little code for their crypto. Is that what you really want for your money? That if all of a sudden you lose a passcode, it's gone forever? Well, there's a way around it. Regulation. Wasn't that against the whole idea of cryptocurrency? Do you want to be able to wire money to somebody and never be able to see where it went? Are you kidding me? That's insanity. If you like that idea, you're not involved in real business. It's absolutely insane. And then there's the Michael Saylor idiot of the world who says that it's a hedge for inflation. When the 1 year we had big inflation, cryptocurrency collapsed alongside the NASDAQ. Guys, it's just stories being said. I could tell you all day long today that I'm a duck. But if I don't look like a duck, walk like a duck, or talk like a duck, I ain't a duck. Cryptocurrency can talk all day long about being some currency. But if nobody's using it to buy stuff, if it's not a store of value, and you might tell me it's a store of value. How is it a store of value? It's a store of value because it fluctuates 10% in a week? Come on. That's the store of value you want? That only happens in crazy countries like Venezuela. Do you want to be Venezuela? Or, oh, the best part is, oh, but Ecuador adopted it. You want Ecuador to be your pillar of Bitcoin and crypto? Are you out of your mind? To me, it's the feeble-minded who believe in this asset. We are stuck in easy money. Interest rates at 0% for years. When interest rates are 0%, any sort of return looks great. Your basis is nothing. You sit there and say, oh, I don't want my money sitting in cash. At least I put it in the S&P in an ETF and get some sort of dividend. That's what creates it. It just builds on itself. That's that slow building process that I talk about. When you buy an ETF, which has become so popular in the last 20 years, when you buy an ETF, they're forced to buy the companies in the ETF. And they buy them based on market cap. So what does that mean? When you put your money into an ETF, S&P 500, 34% of that money goes to buy the top 7 stocks. So what happens to the top 7 stocks? They keep going up and up and up. And that's what's really driving the market, these large cap stocks. If you pull away the Mag 7, the returns on the S&P are not good. In fact, there was a time there where the S&P returns were negative and they were all the positivity was driven by these 7 stocks. But guys, the valuations are getting way ahead of the cash flow, way ahead of the future cash flow. But as long as we keep investing in these ETFs, it's going to keep getting higher and higher and higher. Now, there might be some short-term blips that cause people to exit, pull some money out. But as of right now, it keeps on going because people keep adding money to these ETFs and these mutual funds. So guys, I want everybody to remember something. Your companies, and these companies in the Mag 7, can still do amazingly well and have the stock suffer. That's something to keep in mind. I want to show you an example. Guys, this is Tesla. I cherry-picked this date of November 1st, 2021. Since then, almost 4 years now, the stock is down $80 or 20%. But here's what's interesting. Let's look at their financials. So guys, in 2021, You would have bought based on the previous year's numbers. In 2020, Tesla did $31.5 billion in revenue and had $700 million in profit. Last year, they did $97 billion in revenue and $7.13 billion in profit. 3 times the revenue, 10 times the profit. The stock is down 20%. Why? Why is that? Well, in the short run, stocks are a voting machine. In the long run, they're a weighing machine. Tesla was super, super popular for a very long time. Here's that 10-year chart. Look at this thing. It's up 1,700% in the last 10 years. But look at the last 3 or 4 or 5 years. It has been absolutely flat. Absolutely flat. Even though the business has gotten better. Now, Tesla's going through a rough patch right now. Let's pull up another example. Let's call Amazon, which just keeps on getting better. And here is the 5-year chart on Amazon. It's up 50%. Pretty solid. But for a while there, it was pretty even. Now, let's go back 5 years on the income statement. 2020. $386 billion in revenue. 2024, $638 billion in revenue. 2020, $21 billion in profit. 2024, $59 billion in profit. And the stock has gone where? Has not matched that. Why? It's either undervalued today, it was overvalued back then. In the long run, the fundamentals will drive it. But if you start from an overvalued level, it does not matter. It's still going to suck. That's the example of Cisco from 25 years ago. Let's pull up Cisco and show you. This Cisco is incredible. Max chart. Look at this. The stock's at $68 a share. Its all-time high was $82. It hasn't reached it quite yet, but let's look at the financials. Last year, it did $54 billion in revenue, $10 billion in profit. Let's go back to 1999. It did $12 billion in revenue and $2 billion in profit. 4 times more revenue, 5 times more profit, and the stock is still down from its all-time high. Now, this sounds scary. It isn't scary, but I understand why it feels that way. I'm not here to tell you to sell your stocks. What I'm here to tell you is, this is where stock values go in the long run, but here's where the price goes. My take is, we're somewhere near some really high level here, okay? And we'll go back down to here at some point. The news will be awful here. The news is awesome here. But if you go look at history, you'd always want to be buying here, selling here. Don't sell. What I want you to do is something very, very simple. Take the thinking out of it. I want you to DCA. Dollar cost average. That's your job. Dollar cost average and low cost ETFs that help you reach your goals. Number 2, don't look at your brokerage account. Just dollar cost average every single month, month in, month out. Guys, whenever I log into my brokerage to sign a document, I hide the balance. Because now the market's been up a ton, I don't want to get spoiled by that number. I don't want to look at it and saying, look at how smart I am. Just like if it goes down, I don't want to feel like, oh my God, look how stupid I am. No difference. I want you to do the exact same thing. Avoid looking at it. 3, don't look for the news as guidance. News follows the stock price. When the stock price is up, the news is great. Like I said, when the stock price is down, the news is bad. Frown face. News follows the stock price, not the other way around. And guys, don't just buy because of hype. Don't just buy because the stock is going up. Understand what you're buying. It's very important to sit there and say, what are you buying here? Can you sit there and reasonably project what it's going to make in the future? This sounds like a lot of work. It's not. It's simple work, but it's not easy. That's the different thing. Pick simple businesses. They tend to do very well. Don't get caught up in all the exciting NVIDIAs. Listen, I love NVIDIA, but guess what? What if AI all of a sudden takes a little bit of a turn and all of a sudden people are like, you know what? AI needs to pump the brakes and all of a sudden the orders plummet. What's going to happen then? You think that's crazy? What happened to Tesla? Oh, how quickly things have changed. And that happens all the time. I'm not saying NVIDIA is going to have a big drop. What I'm saying is don't price in perfection when you're doing it. Now, this is why I use our stock analyzer tool in our software, because it does allow me to make assumptions about the future and figure out what is a good price to pay for a company. You got to have some sort of way of valuing a business. I use our very simple stock analyzer tool where I can make 3 different levels of assumptions on revenue growth, profit, multiple for the future, what PE is it going to sell for, and then I put in there, what do I want to make? What is the desired return I want to have? And it spits out exactly the price I should pay for the company based on that. But valuation isn't just a calculator. It's about what goes into the calculator. That's what you need to understand. Now, I talked about our principle-driven approach to investing. And guys, the most important aspect of it is that a great story can become a bad investment if you pay the wrong price. That's exactly what bubbles are. But if you want to hear about the other 4 tenets, there's a free PDF. Click the link below. It'll be emailed to you within 1 minute. It'll thoroughly explain this way of thinking. It's not some shortcut to making a lot of money. It's a way of thinking so you can change the way in which you view money. Everybody out there, all your friends, family who don't try to learn are falling to the wayside and will be hurt when the upcoming bear market happens. And I think it's going to be long, but you can still make money during that time if you're principled and if you have the right stomach inside. And this PDF will help you think about things the right way. And if you want to go even deeper, if you're ready to understand more about what stock you're buying and why, we have a full course. It is linked here on the screen. It's a full investing course. We're going to walk you through every single step of investing in an individual company, how to research them, how to calculate what they're really worth using our stock analyzer tool, and how to build the right portfolio that's framed around your way of thinking. So that when the upcoming bear market does happen, you can look at these as mispricings and not just fear like everybody else. You're not going to look at it as, oh my God, avoid that company. It's absolute garbage. Because mark my words, guys, at some point in the next 10 or 20 years, people will be saying, you shouldn't own NVIDIA, you shouldn't own Tesla, you shouldn't own Apple, all these great companies. The story is going to shift. You're going to be better than that. You're going to be prepared because you're going to realize that people just shifted because the stock didn't go where they wanted because they're overvalued today. And more importantly, you're going to be smarter than over 99% of all other investors out there. Thank you for your time.